This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Welcome back to your TF Metals Report podcast highlights for the week of July 4th through July 8th, 2022, a week that began with the July 4th holiday here in the U.S. Markets closed. So we really got the week underway on Tuesday, July the 5th. And we got taken to Pound Town in both COMEX Gold and COMEX Silver. An event that we discussed last week, if you listen to these weekly summaries, was the coming death cross, as they call it, of the 50-day moving average down through the 200-day moving average. My speculation then was that might lead to a capitulation of selling, kind of like what we saw back in early January before a big rally in February into March. Well, we got that selling. The death cross came on Wednesday, but man, it really kicked in on Tuesday. That's all part of what we discussed. Again, Tuesday, July the 5th. Here's your gold chart showing you that death cross is coming tomorrow. The 50-day at 1851, the 200-day at 1850. They will cross tomorrow. That will likely lead to some technical selling at the COMEX Open. You see that day back in late January when they crossed, and look at how that dumped that day, then dumped the next day, and then turned. So where would we look for some support? Well, 1760 really should be support, and I don't want to talk about 1720 since we were just talking about 1820, but after a day like today, who knows? All I know is the RSI now all the way down here at 27. So we're due for an oversold technical bounce at a minimum. That selling did continue into Wednesday, July the 6th, and it prompted us to take a look at the long-term chart, the weekly chart of COMEX Gold as we begin to search for support levels that will be important if price continues to decline. It also led me to think about the period in 2013 where gold was crushed and broken down through its 200-week moving average, and what a bad time that was for all of us, and we don't want to repeat it. Again, we discussed a lot of things on Wednesday, July the 6th, but here's just a part of it. So where might gold bottom here? I don't know. Am I grasping at straws? As you can see, gold came down after that spike coming out of COVID. Came down several times last year to this, near 1720, 1700, even 1680 level. And you can see after QE, before it really blasted off in the summer of 2020, there was also a lot of support between about 1680 and 1700. Is that where we're headed? Well, maybe by the time we get there, that's where the 200-week moving average will be too, which is what we sprung higher from in late 2018 at the last Powell pivot. So where is support? Well, it's not. On the long-term chart, we're not there yet. We're not there yet. And I tell you all that because I want you to see the next chart. Again, I just mentioned, I remember thinking in 2013, well, the physicals, market will support gold, and it didn't. And once gold got washed out and smashed, remember, this was like over a 2-day period. It was trending lower, but it was Friday the 12th of April, 2013, and Monday the 15th when price fell $200 from $15.50 to $13.50, down 61 day, down 140 the next. Tried to get back above its 200-week moving average over the period of the next 3 weeks, and the bottom fell out, and then it was hell and torture for a couple of years after that. This we don't want to have happen, okay? Our Thursday conversation this week was with my old friend Denver Dave Kranzler of Investment Research Dynamics and the author of the great subscription newsletters Mining Stock Journal and Short Sellers Journal. Dave's been in the securities industry his whole life, 35 years now maybe, and he's certainly an expert on how the markets operate. And so it was great to get his opinion on a lot of things that appear to be going on behind the scenes, especially in the EU banking sector. Of course, your Thursday conversation is always a free public thread, so if you want to hear the whole conversation, just go to TF Metals Report, go to the home page, and the link's right there for you to click and listen. Here's just a small sample of what Dave and I discussed.
It reflects, massive credit problems brewing, both here and in Europe. And for me, the best indicator of the credit problems going on in Europe is, one, if you look at a daily chart of Deutsche Bank's stock price, it's down like 50% since February. And Deutsche Bank is the most systemically dangerous bank in the world. It's been kept on life support since 2008 by the German government, the Bundesbank, ECB, Bank of England, and the Fed. And I don't know if it's true anymore, but back then, Deutsche Bank's, the size of its assets, and we know most of them were crap assets, was larger than the German GDP. So,
right.
Unless they wanted to completely incinerate their country, they kind of had to keep it alive. Not that it's going to fix the problems, it just kicks them down the road. And then you mentioned Credit Suisse, and everyone saw that the chart going around yesterday of the cost of credit protection against Credit Suisse, right? It's basically the spread over treasuries on the cost of buying a credit default swap to protect if you own Credit Suisse debt, or if you want to speculate on the demise of Credit Suisse, you buy basically a credit default swap, which is insurance against default. So, and it's back to where it was in 2008. Now, Credit Suisse, Deutsche Bank, Citibank, Goldman Sachs, JP Morgan, all these banks, if they didn't bail them out in 2008, would have gone bankrupt.
Right.
And so, as we were chatting about earlier, and it ties into what's going on in the precious metals market, I'm pretty convinced that what we're going through right now and what we're looking at and what's coming at us is very similar to what happened in 2008, only it's going to be much worse this time, because the derivatives are, even though they goofed around with the accounting rules to make it easier to hide the true derivative exposure of these banks, derivatives outstanding are larger on a notional basis. And, there's obviously a lot more debt globally, but especially in the US and the EU. And a lot of that debt is once again, subprime debt. It's not, back in 2008, a lot of it was connected to the mortgage market, although certainly not all of it, but now it's frickin' everything.
Friday, July the 8th brought the latest edition of the U.S. Jobs Report, which at TFMR we call the BLS BS, because it comes from the Bureau of Labor Statistics, and it's full of BS. This report this month was no different from any other. It did allow a slight rally in both COMEX gold and silver on Friday, but we're still going to finish up the week looking pretty lousy. Very tough week. And importantly, on COMEX silver, the second week in a row below its 200-week moving average. Your final chart this week shows you 10 years of price history, showing price gapping down below this important long-term technical indicator back in 2013, and then it took years fighting it as resistance, trying to get back above. So we want to turn around and get back above this level as soon as possible. We couldn't do it this week. Can we do it next? Next week, of course, be very important economically. We get the CPI, we get the PPI, we get the latest data on retail sales. So we'll see how we go next week. I invite you to check back next week for another edition of these podcast highlights. And of course, we invite you to join us at TFMR. It's only $15 a month, and it's money well spent. Just stop by tfmetalsreport.com for more details. Have a great weekend, everyone.